नमस्कार दोस्तों, अगेन सचिन फ्रॉम फील गुड वेल्थ क्लब। दोस्तों, हम अच्छे तरीके से वेल्थ मैनेजमेंट करने के लिए लोगों को सर्विस दे रहे हैं और ये कस्टमाइज सॉल्यूशंस होने के कारण काफ़ी इफेक्टिवली ये काम कर रहे हैं। और हमारे जो भी दर्शक हैं उनके पास काफ़ी अच्छे तरीके से इजी तरीके से इंफॉर्मेशन जाए, उनको अलग अलग पड़ाव पे अलग अलग काम, अलग अलग पड़ाव पे एक अच्छी सर्विस मिले, एक अच्छा सर्विसेज का अनुभव हो, ऐसा ही सोच के हम ये वीडियो बना रहे हैं। ये वीडियो है NISM 21A। ये जो एग्जाम का जो रेफरेंस मटेरियल है उसका चैप्टर नंबर 9 हम यहाँ पे स्क्रॉल करेंगे, रीड करेंगे साइमल्टेनियसली और लिसन भी करेंगे। तो ये जो भी एस्पिरेंट्स है ये एग्जाम देने के लिए, उनके लिए ये सुविधाजनक रहेगा। ये मनीषा से हमने ये वीडियो बनाया हुआ है। तो लेट अस मूव टू द चैप्टर नंबर 9, portfolio management process. Learning objective of this chapter is, after reading this chapter, the reader should be familiar with, first, the importance of asset allocation decision, steps in portfolio management process, need and constituents of investment policy statement, difference between strategic and tactical asset allocation, benefits and difficulties of rebalancing of the portfolio, importance of the asset allocation decision. This is the first point. Asset allocation is the process of deciding how to distribute the investors' wealth into different asset classes for investment purpose. An asset class is defined as a collection of securities that have similar characteristics, attributes, and risk-return relationship. For example, bonds, equities, cash and cash-like securities. A broad asset class such as a bond can be divided into sub-asset class like treasury bond, corporate bond, junk bond, etc. The equity can further be divided into the large cap, mid cap, and small cap. Now, the asset allocation decision is a very important investment decision. Professional investment experience has been suggesting that in the long run, asset allocation decision majorly influence the performance of the investment portfolio. The asset allocation decision is not an isolated decision, it is a component of portfolio management process. Now, the second point, understanding the correlation across the asset classes and securities. Correlation measures the strength and the direction of relationship between the two variables. Correlation coefficient vary in range -1 to +1. A value of +1 or -1 indicates the perfect positive negative relationship. Positive or negative correlation indicates a strong or inverse relationship between the two variables. Understanding the correlation across the asset class is very crucial in making asset allocation decision. In fact, as can be seen in 9.1, investment that are part of same asset class are sensitive to the same major economic and investment factor or investment factors. Hence, the correlation between the investment that are part of the same asset class is expected to be high, where a correlation between two different asset classes is expected to be low. Just repeating the same sentence again. Hence, the correlation between investment that are part of the same asset class is expected to be high, where the correlation between two different asset classes is expected to be low. In normal circumstances, these assumptions hold good. Correlation is the most relevant factor in reaping the benefit of risk diversification, that is, in reducing portfolio risk. Correlation among asset class returns can and do change over time and different economic situations. Asset return correlation in further may also differ from those observed in past because of the changing economic and market regimes. Investors should take these factors into consideration while making asset allocation decision and should not solely depend on past correlation metrics. Again, repeating, it is very important point. Investors should take these factors into consideration while making asset allocation decisions and should not solely depend on past correlation metrics. 9.3. The next point, steps in portfolio management process. Portfolio management process involves the set of integrated activities undertaken in a logical, orderly, and consistent manner to create and maintain optimal portfolio. The elements in the portfolio management process are planning, execution, feedback as discussed below. The first step is the process of portfolio management is development of a policy statement for the portfolio. It is a low roadmap that identifies investors' risk appetite and defines investment objective, goals, and investment constraint. The second step involves the study of current financial condition and forecast future trends. The third step is construction of portfolio after taking into consideration policy statement and financial market forecast. Investor need and financial market forecast being dynamic, portfolio requires continuous monitoring and rebalancing. The third step is construction of portfolio after taking into consideration policy statement and financial market forecast. Investors need the financial market forecast being dynamic and portfolio requires continuous monitoring and rebalancing. The fourth step is portfolio management process in performance measurement and evaluation. Thus, the portfolio management process moves from planning through execution and then to feedback. Investment policy statement. This again we are once again 9.3, just I am repeating because it is very important. The first step in the process of portfolio management is development of the policy statement for the portfolio. It is roadmap that identifies investors' risk appetite and that defines investment objective, goal, and investment constraint. The second step involves study of current financial condition and forecast future trend. The third step is construction of the portfolio after taking into consideration the policy statement and financial market forecast. Investor needs and financial market forecast being dynamic, portfolio requires continuous monitoring and rebalancing. The further step of the portfolio management process is performance measurement and evaluation. Thus, the portfolio management process goes from planning through execution and then feedback. Investment policy statement, that is called IPS. Development of investment policy statement is the key step in the process of portfolio management. IPS is the roadmap that guides the investment process. Either investor or their advisor draft the IPS. The investor or their advisor draw their IPS specifying their investment objective, goal, constraint, references and risk they are willing to take. All investment decisions are based on IPS considering the investor's goal and objective, risk appetite, etc. Since the investor requirement changes over a period of time, IPS also need to be updated and advised periodically. IPS form the basis of strategic asset allocation, which is essentially an interaction between investor risk return requirement and the expected investment return. Now there is one point. Financial service data integrator like Bloomberg, Capital IQ, etc. provide information on correlation coefficient between various asset and securities. Alternatively, users can calculate correlation coefficient using the simple Microsoft Excel function. Okay. Now, need of IPS. Why the IPS is needed? IPS is an important planning tool with the help of investor understand their requirement and also help portfolio manager in creating and maintaining the optimum portfolio for the investor. Preparation of IPS inculcates a disciplined system of process in managing the investment. It reduces the possibility of making inappropriate decisions. There are four important purposes of policy investment serve that policy statement serves. It enables investor to have a realistic return expectation from their investment. It enables portfolio manager to make the effective investment decision. It provides a framework for portfolio managers evaluation with the respect to the investment. It protects the investor against portfolio managers inappropriate investment decisions or unethical behavior. In summary, a well-defined policy portfolio goes long way in serving the investor's interest. It enables construction of the optimal investment portfolio. Constituents of IPS. Since IPS is the most important document, it needs to be prepared with caution. The investor has be upfront with the advisor and portfolio manager with regards to their financial situation. Since IPS is the most important document, it need to be prepared with caution. The investor has be upfront with the advisor or portfolio manager with the regard to their financial situation, requirement, and risk-bearing temperament. The advisor or the manager preparing the IPS is also required to show utmost patience to obtain a deep understanding of the investor profile. The investment objectives. The investor objectives are identified in relation to the risk return liquidity. Investors may state their investment objective in terms of desired return in absolute or relative sense. They need to bear in mind that risk and return have typical positive relationship. High the risk, higher the return. On the other hand, liquidity has inverse relationship with return. The liquidity has inverse relationship with return. Relatively, illiquid investment requires premium for being less liquid. That is illiquidity risk premium. Generally, the investors invest for preservation of capital, regular income, and capital appreciation. The investment objective lead to asset allocation decision. If the investment objective is capital appreciation, then investment need to be high return investment like equity. Of course, these investments will have higher risk than government securities or bank fixed deposit. On the other hand, if the capital preservation is the primary investment objective, asset allocation will tilted towards the safe bonds and debt securities. If regular income in the investment objective, fund will be invested in asset class generating periodical income like the dividend, paying stock, and interest paying bond or rent paying realty. Investment constraints. Constraints are limitations on investors to take exposure to certain investment opportunities. Constraint relates to investor liquidity needs, time horizon, and other unique need and preferences. Liquidity constraint. Different investors have different liquidity requirement. Younger people usually have lesser liquidity requirement than the older people. Some may have some health or medical concerns which requires them to maintain its certain liquid fund. Others may have requirement of college fees or wedding in the family or some other needs. Generally, investor refers to have liquid funds to meet their two-day expenses. Additionally, they may like to keep some amount of liquidity to meet the contingency requirement like sudden medical expenses, etc. The needs of liquidity fall into the following categories. Emergency cash. The emergency cash reserve is usually measured as 2 or 3 months spending, but it could be more if the individual source of income is at risk or volatile. Near-term goal. These needs very high with high individual for known goals due within year. The amount needed to achieve these goals should be in asset with relatively good liquidity. Now, just repeating near-term goal. These needs vary with the individual. For known goals due within year, the amount needed to achieve these goals should be in asset with relatively good liquidity. Investment flexibility, the ability to take advantage of market opportunities as asset class become overvalued and undervalued would require greater degree of liquidity. The ability to take the advantage of market opportunities as asset class become overvalued and undervalued would require greater degree of liquidity. To meet such requirement, some portion of the portfolio should be in cash or cash-like securities. The advisor or the manager need to take detailed assessment of the liquidity needs of the investor. Keeping too much money for liquidity may hit the overall portfolio return. On the other hand, not maintaining a sufficient liquidity will lead to inconvenience and selling of the other investment untimely. The liquidity constraint of an investor need to be clearly specified in IPS, regulatory constraint. Generally, individual investors do not have many regulatory constraints, but if there are any, they need to be followed. Regulations can also constrain the investment choices available to the investor. For example, as per the Reserve Bank of India notification, liberalize retirement scheme, an Indian resident individual can only invest up to dollar 2,50,000 overseas per year. Indian resident individual investors cannot make investment greater than the amount specified by the regulator. Another example is the sale or purchase of securities on the basis of information that is not publicly known. Usually, people who have access to such information are insiders of the company and they are prohibited from trading on the basis of the insider information. Tax constraint. Investment process is complicated by the tax concern. Tax players a very important role in portfolio management and drives investment decision. Different investment and different kinds of income are taxed differently. Return in the form of income like interest, dividend, rent versus return in the form of capital appreciation are taxed differently. The same form of return may attract different tax liability depending on the tax bracket the recipient belongs to. Hence, a thorough understanding of the tax code applicable to the investor needs to be a part of IPS. Exposure limits to different sectors, entities, and asset classes. As per the SEBI PMS regulation 2020, the agreement between the portfolio manager and the investor should include the investment approach. As investment approach is a broad outlay of the type of security and permissible instruments to be invested in by portfolio manager for the investor, taking into account factors specific to investor and securities. It should also include type of instrument and proportion of exposure. After taking into consideration the investor's objective, risk appetite, liquidity need, tax and other regulatory constraint, time horizon and investment, exposure limit to specific sector, entities, and asset class can be set to avoid the concentration risk. The portfolio manager needs to adhere to this exposure limit with managing investment. Unique need and preferences. Unique needs and preferences. Sometimes investors have idiosyncratic concerns. They may have personal, social, ethical, cultural, preferential beliefs. For example, an investor may not want her money to be invested in the stocks of companies selling environment harmful product. Another example could be an investor owning stocks of company in which she is working and is reluctant to sell the same even when it is financially prudent due to the emotional attachment. Now there are some sub points. Under the liberalization remittance scheme, all resident individuals, including minor, allowed to freely remit up to USD 2.5 lakh per financial year, April to March, for the permissible current capital account transaction of combination of the both. Further, resident individual can avail foreign exchange facility for purpose of mention in para 1 of Schedule 3 of FEMCAT Amendment Rule 2015, dated May 26, 2015, within the limit of USD 2.5 lakh dollar only. The scheme was introduced on February 4, 2004, with the limit of USD 25,000. The ARS limit has been revised in stage consistent with prevailing macro and microeconomic conditions. Just it is the star point. The point is that each investor is unique, and if he has any specific preferences, the same should be clearly specified in IPS. In addition to the above mentioned section, the IPS may also include reporting requirement, portfolio rebalancing schedule, frequency of performance communication, investment strategy and style, etc. Now, the next point, 9.3.6, assessment of needs and requirement of the investor. Investor के needs and requirement, need and requirement. The investor invests to meet their various goals and objectives. The assessment of the needs and the requirement of the investor is critical in making investment decision. People have many financial goals. Some are to be achieved in near term, some are medium or long term goals. Goals also have different priority. Some are high priority goals, whereas others are not be very important to achieve. Investors can put their needs and goals down along with the priority of the time frame for each those goals with the funds needed for the same. A pro forma for creating a goal sheet is shown in 9.1. Number, goal, priority, time period, amount needed. Near-term high priority goals have a high emotional priority with the investor wishes to achieve within just a few years at most. As a result, investment vehicle for these goals tend to be either cash equivalent or fixed income instrument with the maturity dates that matches the goal date. For a people of limited to modest means, the cost of not achieving those goals is just too great to take a risk with more volatile approaches. For many investors, building a retirement corpus is a long-term, high-priority goal. When the investor starts planning for the goal well in advance, they have enough time to accumulate the corpus. Because of the long-term nature of such goal, a diversified approach utilizes several different classes of assets in usually preferred. People also have many low-priority goals. These are goals that are not particularly painful if they are not achieved. This could range from buying a farmhouse to a luxury car. For these goals, more aggressive investment approaches are usually taken. Analyzing the financial position of the investor. A convenient way to analyze the financial position of the any constructing financial statement. This helps to organize financial data in a systematic way. Personal financial statement includes statement of net worth balance sheet and income expense statement. For calculating the net worth, all the asset the investor owns, that is the house, the car, the investment in stock, bond, and mutual fund, balance in a saving account, value of the jewel owned, and the value of all other financial assets and the real asset are to be reordered at the estimated market value. Then all the liabilities need to be subtracted from the asset. Liabilities may include the outstanding car loan amount, credit card loan, home loan, and any other amount he owes, like the personal loan, education loan, etc. The difference between the value and asset and the liability is net worth. It is suggested that net worth is to be calculated periodically, at least once in a year. The next step is calculating whether the person's present income exceeds the spending and by how much amount. This is amount which could be available periodically for investment purpose. The income expenditure statement can be prepared on monthly basis. Psychographic analysis of the investor. The investor process, investors' behavioral traits and personality characteristics also play an important role in setting investor risk profile. Psychographic analysis of the investor bridges the gap between standard finance, which treats investor as a rational human being, and behavioral finance, with rational human being, and behavioral finance, which view them as normal human beings who have bias and make cognitive errors. In other words, psychographic analysis in investor recognize investor as a normal human being who are susceptible to bias or irrational behavior. All investors have unique personalities, though it is difficult to categorize the personalities because they all are human beings and they are so different. Some basic classification system has evolved after year of research. These are many frameworks available to perform psychographic analysis. For illustration purpose, given below is the framework given by Billard Bell Kaiser, BBK. The investors have unique personalities, though it is difficult to categorize the personalities because they are human beings and they are so different. Some on the basis of classification system has evolved after years of research. There are many frameworks available to perform psychographic analysis. For illustration purpose, given below is the framework given by Billard Bell Kaiser, BBK. Billard Bell Kaiser classification investor personalities by focusing on two aspects: the level of confidence and the method of action. The first deal with how the investor approaches life in terms of career, wealth, or money. Level of confidence and method of action. The second element deals with whether the investor is careful, methodical, and analytical in approach towards life. The two elements can be thought of as two axes for individual psychology. One axis is the confidence, anxiousness, and the other is carefulness, impatience. Carefulness or impatience. The different personality characteristics are shown through the exhibit of 9.2. Investor personality characteristic: confident, anxious, careful, and impatient. Now you can see the axis. The horizontal axis is careful, impatient, and the vertical axis is confident, anxious. The five personalities, the upper right corner of exhibit 9.2 represent the adventurer people who are willing to put it all in one major bet and go for it because they are confident. As far as they are concerned, it is carefully considered decision. It is a carefully considered decision. They are confident as well as impatient in that quadrant. One typically will find entrepreneurial people who are willing to stick their neck out in their career or in their money management strategies. They normally have their own ideas about investing. They are willing to take risks and they normally do not go for the investment advisors. These prefer concentration their bets. They prefer concentrating their bets. Lower right quadrant of the exhibit is the celebrity quadrant. The lower right quadrant of the exhibit, lower right, celebrity quadrant. These people like to be where the action is. They are afraid of being left out. These investors will keep bringing up the latest hot topic, asking, should I bet this? Should I be in this? Or what? They really do not have their own ideas about investment. These people normally go for investment advisor. However, they are the most difficult investor because of their own belief. The individualist is the upper left quadrant. These people have certain degree of confidence about them, but they are also careful, methodical, and analytical individualists like to do their own research and tend to avoid extreme volatility. They are often they are often constrained investors because they do sit back and think about where they want to go and which investment make good value sense. The lowest left quadrant represent a guardian personality. They typically, as the people get older, being considering retirement, they approach with personality profile. Guardians are people who are cautiously trying to preserve their wealth. They are definitely not interested in volatility or excitement. Finally, there are always people who are so well balanced that they cannot be placed in any of the specific quadrant. So they fall near the center. These investors are called straight arrow investors. On average, this people of investor is relatively balanced composition of each of the other four investor types, and by implication group willing to expose to medium risk. It is also worth noting that each investment has times exhibit some characteristics of personalities other than his normal one. This can be particularly influenced by his most recent investment experience. A guardian can become more aggressive for a time, like an adventure if he is on winning streak. Conversely, most investors become more guardian-like just after an event with high heightened volatility. Experience has shown that each of the five types of investors require different approaches in portfolio management. Life cycle analysis of the investor. It is important to understand the various stages in the life cycle because of the impact they have on the investor's risk appetite. Exhibit 9.3. Exhibit 9.3 risk return trade off for investors. Return, risk, lower risk, higher risk. Every investor has thought about whether she might be along that line, especially when the points are described in terms of risk and return. Generally, younger individuals who are just beginning to earn money tend to be on right side of the line, while older individuals move increasingly towards the left side of the line. This life cycle of investment can be broken into phase, the accumulation phase, consolidation phase, spending phase, and a gifting phase. This is described in Exhibit 9.4. Accumulation phase. During this phase, net worth is typically small relative to the liabilities. Investments are fewer and typically non-diversified. Goals may include children's education, house, and if possible, investment for future finance independence. Since the individual has very long time horizon and potentially growing income stream, she can undertake more high return, high risk capital gain oriented investment. Consolidation phase. The consolidation of the mid to late career stage of typical life cycle is characterized by the period when the income exceeds the expenses. As a result, this stage is characterized by consolidation of investment portfolio at this time. While the time horizon to retirement is still relatively long, investors may start looking for capital preservation. High capital gain investments are balanced with some lower risk assessment. Spending phase. This is the period when the living expenses are covered not from income but from accumulated assets such as investment and retirement corpus. Because of the heavy reliance on investment in this phase and unlikely to going back to work, the focus is on stability in investment portfolio. Preference will be on investment that generate dividend, interest, and rental income. As investors' time horizon, they will still be well over 15 to 20 years. So some investment in the portfolio should continue to have a growth and inflation hedge potential. Gifting phase. This is the final phase when the person realizes that she has more asset than she need for spending. In such cases, the attitude about the purpose of investment does change. Investment at this stage may be made to leave legacy, support, and charitable cause, etc. It is important to note that boundaries between the stages are fuzzy on the time scale. Forecasting risk and return various asset classes. Portfolio management is the process of integrating two sets of information. The first set of requires input have already been listed above, that is investment objective, goal, requirement, personality type, phase in the life cycle, liquidity need, tax and other constraint, etc. Second set of requires inputs in the capital market forecast, that is establishes the expected risk return opportunities available to the investor as discussed in chapter 3. The various investment opportunities available to the investor need to be listed and their returns need to be forecasted along with the possibilities of deviation in those returns. Historical risk return on various asset classes provide a good starting point to understand the relationship between risk and return and proceed to have make the forecast about their future return possibilities. Benchmarking the client portfolio. The investment policy statement need to provide a framework for evaluating the performance of the portfolio. It will typically include benchmark portfolio which matches in composition of the investor's portfolio. The idea is to compare apple with apple. If the investment is made in large cap equities, then the BSE 30 or Nifty 50 index can be an appropriate benchmark. If the investment is made in long-term bond, the bond index with similar maturity and credit profile will be appropriate benchmark. The first statement is important. The investment policy statement needs to provide a framework for evaluating the performance of the portfolio. Asset allocation decision. The interaction between the two sets of information about the investor, about the risk return, and the investment opportunity culminates into asset allocation decision. The asset allocation decision follows logically from investors' needs and goals, risk preferences, and liquidity needs. After developing a forecast on risk and return on various asset classes, the portfolio manager has to decide the mix of asset that maximizes after tax return for the investor. Strategic versus tactical asset allocation. The asset allocation decision, which is made after taking consideration investors' characteristic of strategic asset allocation. It is the target policy portfolio. It provides target allocation among the major asset classes. In this sense, it is essentially a translation of an investment policy statement into asset weight. Strategic asset allocation is the long-term asset allocation decision. Strategic asset allocation is designed to meet the investor's goals and objectives over a long period of time. There is, however, the dynamic component to asset allocation. Tactical asset allocation. Tactical asset allocation is a short-term asset allocation decision. These decisions are taken more frequently than SAA. The idea behind TAA is to take advantage of the opportunities in the financial market. When market conditions favor one asset class over the asset, the portfolio manager may temporarily shift money from one asset class to another to exploit the discrepancy in market with a few to earn returns. In technical asset allocation, portfolio manager time market. In it, that is, determine which asset class are likely to go up for that more than expected and which less than expected, when they will alter the target asset allocation accordingly. Thus, if a portfolio manager believes that the stock market is overvalued and it is up to for correction, while debt market is undervalued, then he may reduce the proportion of portfolio that is allocated to equities and increase the proportion allocated to debt. After looking the gains, the portfolio needs to be rebalanced purpose the target rebalance to pursue the target allocation. Thus, TAA attempts to beat the market. SAA decisions involves time in the market, whereas the TA is timing the market. Importance of asset allocation decision, empirical support. Asset allocation is considered as the most important investment decision. This is because asset allocation is the major determinant of risk and return for given portfolio. There is a huge empirical support for the same. Brinson Hood Bibower 1986 in a landmark paper concluded that portfolio's target asset allocation explain the majority of the broadly diversified portfolio return variably over time. These findings were confirmed by Boston, Roger, and Paul in 2000, suggesting that portfolio's investment policy is an important contributor to return variability. Across all portfolios, asset allocation decision explains an average of 40% of the variation in fund return. For single fund asset allocation, explain 90% of the fund's variation in return over time. Across all portfolios, asset allocation decision explains an average of 40% of the variation in fund return. For single fund asset allocation, explain 90 single fund asset allocation explain 90% of the fund's variation in the return over time. Now, rebalancing of the portfolio. 9.6. The portfolio needs to be continuously monitored and periodically rebalanced. This need of rebalancing arises due to the price change in portfolio holding. Over time, asset classes reduce. Over time, asset classes produce different returns that can change the portfolio's asset allocation. To keep the portfolio's original risk and return characteristic, portfolio may require rebalancing. Portfolio may also require rebalancing due to the change in investors' goal and objective, risk tolerance, etc. If the IPS should include policy regarding the rebalancing of portfolio, answering questions relating to the rebalancing like how often and how much. That is, if the periodically of the portfolio rebalancing and tolerance for deviation for the target policy portfolio. 9.6.1 benefits and difficulties of rebalancing. Portfolio rebalancing involves the simple trade-off, the cost of rebalancing versus the cost of not rebalancing. While deciding the frequency of the rebalancing, trade-off between the cost of doing it and not doing it is to be arrived at if the investor's target asset allocation is considered optimal. Any deviation from is due to the price fluctuation is undesirable. However, rebalancing costs need to be borne in mind. There are two types of cost: transaction cost and tax cost. The transaction cost is the time and money cost like research cost, brokerage, etc. for buying and selling securities. Relatively illiquid investment like private equity and real estate pose challenges in rebalancing as they pose high transaction cost. Rebalancing is rebalancing is comparatively easier with relatively more liquid asset like listed equities or government bond. While rebalancing the portfolio, managers sell asset, usually the appreciated asset, and buy usually the depreciated asset. Portfolio managers often set price target for buying and selling securities. Such actions attract tax liability, which also should be kept in mind while deciding the frequency of rebalancing and tolerance for deviations. Now this is the chapter end of chapter 9. Congratulations. This first step is to investment. Now these small sample questions are there. Let us have a look at this sample question. The first step in the investment process is the development of objective statement, not investment policy statement. Perfect. Then which of the following is considered to be the investment objective? Capital preservation, capital appreciation, and current income, all above. Asset allocation is the process of dividing funds into asset classes. Phase is the stage when the investor in their early to middle age attempt to accumulate asset to satisfy near-term need. Example, children's accumulation phase. Correct. Which of the following is the step in the portfolio manager process? Develop a policy statement, study the current financial economic condition, construct the portfolio. All of the above. Congratulations, this is end of the chapter 9.